All righty, folks, we have the one and only Lance Lambert, who goes by the moniker of housing, housing, housing. I think it is important to recognize, as we are already at the end of January 2024, that the housing bears that dominated the market, with some folks calling for a 10 or 20% decline in home prices, seem to have gone back to hibernation. They seem to have capitulated. We can also talk about demand, as we have seen a noticeable uptick in mortgage demand, which is a leading indicator to purchases. What's going on, Lance? A lot of stuff going on.
Housing, 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 always a ridiculous amount of stuff going on. One thing to start out before we jump into it is just to, stay on your toes when you see headlines. I saw a headline from Newsweek this week about some experts saying a foreclosure wave was going to hit the housing market. I clicked the story and it was about office buildings, the expert was talking about. And so the headline said housing market, and the story was all about office space. Stay on your toes out there,
Oh,
which
that's
your
funny.
audience knows. But it's interesting what sometimes passes is
Yeah.
journalism.
Well, everybody's got to get the clicks, man. And we obviously know in YouTube land, the doomers and crash bros get the clicks. They aren't right, but they still get the clicks. So it's funny to see that Newsweek is even saying housing market in the office is the article. That's crazy. But
Yeah.
let's talk about housing bears. We had some housing bears talk about 10%, 20% crash, maybe 12, 18 months ago. It didn't happen. But yeah, they've all seemed to have capitulated, and now they're all kind of at zero or above.
Yeah. So when the mortgage rate shock started to occur, at the time, actually, most of the models still thought there would be a lot more growth that would occur into the market. Zillow actually still thought there was like another 17%. Now, at the same time, what started to occur is a few of the people, like Mark Zandi over at Moody's Analytics, Mark told me in the spring that we were going into a housing correction, which he was right in my view. His initial call ended up being what happened, which his initial call at the time was that the next 12 months in May, there would be 0% home price appreciation, and that Boise and Austin would fall somewhere between 5 to 10. But that was also when mortgage rates were at 4.5, heading to 5.5, would hit 6. But what occurred is that summer, mortgage rates went higher than the experts thought. And so they moved their model. Their models moved up and put in more of mortgage rates staying higher for longer. And this is when you started to get bigger drops in the prices in the models. And it started to make a bit of sense because we saw housing for a bit destabilize with absorption moving up really fast. Not everywhere, but actives moved up really fast in Phoenix. Like that was weird. Boise, never really in the West Coast necessarily, but they did see prices come down at the top of the market, especially. Austin saw the actives move up very quickly, some other parts of these boom towns. And that's when in the summer, Zandi changed his to a 5% peak to trough for the market. And it would actually, the more interesting thing about his model wasn't necessarily how far we would fall, it's how long we would take to recover. So the Moody's model was never the most bearish on how far we would fall, but it thought we would stay down for a while, that housing would struggle to get back, which isn't what happened, of course. So following along this timeline of the forecast, then in October-ish, September-ish, Zandi's model changed again, and it became like 8.4% peak to trough. And then he, said his outlook was 10% peak to trough. And if the market actually went into a recession, a downturn, which Zandi never came out and forecasted a recession, but if that had occurred, he thought it would be 15 to 20% on the national market, which that would have been a big number.
That would have been a big number, yes.
So what ended up happening is that the first half of 2022, home prices raced up at 10% in 6 months. They shot up 10%.
That's an annualized number, right? 10% annualized?
No, that's not annualized.
Wow.
Just how much? 10%. Yeah. Now, some of that could be lagging but January to June, 10%. Now, some of
Okay.
that could have been closings in like November, December, and but it's still 6 months,
I got it. Yeah.
10%. And year over year in 2021 was 21, by the way. But in 2022, 10% in the first half. Now,
Okay.
what happened in the back half of the year is that half of that got knocked off on a
Right.
national level. Now, remember, this is Case-Shiller, so it's all single family homes. The bottom of the market probably less, top of the market it was probably more, and this was very concentrated in the Western markets, which are more
Yeah.
rate
In
sensitive.
2022. Yep. Yep.
Yes.
Yep.
And so peak to trough, we ended up falling 5%, but we still ended up almost 6% for the year. So it was kind
Got it.
of this weird thing. But
Yeah.
then what occurred is in the final months of 2022, inventory stopped racing up. It actually started tightening up faster than expected in markets like Phoenix and Las Vegas. Mortgage
Yeah.
rates came down a bit and the market stabilized. And
Yep.
prices since then have been drifting at like a historically normal number. Now, there was some softening in the second half of 2023 with mortgage rates going to 8, but it never got to the destabilization of 2022. And the
Correct.
reason that it even destabilized wasn't because of a lot of uh, stress in the market. It wasn't because of bad loans, any of that. It was because affordability deteriorated at such a fast rate. That was the fastest
Exactly.
ever deterioration. So for a period of time, and remember, a lot of the investors in the market or buyers in the market or sellers remembered '08. And the headlines were kind of not scary. And so people did give up faster on price a little bit if they had to sell at the end of 2022,
Yep.
especially in October, November, December. But once the market stabilized, that changed. That all changed. Now, since then, a lot of the models in January, February of last year stopped being bearish once the market stabilized. And slowly throughout the year, there was capitulation among housing price bears, call them bears, that who just, not necessarily super bearish, but thought prices would fall further.
Right.
And they walked that back. And now Zandy, he was forecasting -4 for 2024. And then the new model they just did for January, which they do it quarterly, shows pretty much zero. It might be like -0.3 or something. I got to do the math on it. But they've capitulated now and they don't think there's more declines coming. Or the declines they think are coming, I'll need to look at the model more, or it looks like they'll be regional, they think, but nothing
Yeah.
like they thought before.
Yeah.
And so despite the fact that affordability is stressed to levels that we haven't seen in 4 decades, the fact that the deterioration and the rapid move is behind us, and
Yep.
the fact that the market has stabilized and prices are moving up again, looks like it has the models stabilizing.
Yeah, I know you sent out a tweet or whatever we call them these days, kind of getting real estate agents to kind of reach out to you to tell you what's going on the ground. I talked to probably in the last 7 days, 20 to 25 real estate agents, and they are pretty dominantly West Coast, but there are some on the East and Central, and most of them are telling me these are all kind of median and below. All they're telling me bidding wars are back.
Yeah,
It's
well, so
wild to think about.
the technicals in the market is there's not a lot of active listings. And, the truth of housing is while for 6 months in 2022, it wasn't the true, but historically, when you're under 6 months, 5 months of inventory, prices move up. It's not, I wouldn't think of inventory and months of supply is just supply. It's really the equilibrium of the market.
Correct.
And the fact that it isn't moving up quickly and it's kind of stagnated tells us, and the fact that prices are moving up in this environment tells us that's where we are, is a place where probably prices in a lot of these markets are going to drift up, especially in the first half of this year. It's just how it works. And the
Yeah.
reason that housing moves upward long term is that people can leverage 30 years of future income. That's what
Exactly.
happens. What buys housing isn't necessarily income today, it's also income of the future, and people leverage it. And we have these fixed mortgages, and and there's this natural rate of inflation in the economy.
Mhm.
And they are making more money. It's one thing that can be printed,
Yeah.
uh, although not a lot right at this very moment.
Right.
But naturally, housing drifts up long term.
Yeah, well, it's really fun to see the crash bros or housing bears really understand that um, the second half of 2022 was a moment in time. And I talked to flippers who were losing six figures because they had the inventory come on market at the wrong time. Demand really did drop off. Demand did drop off when rates hit 8%, but it was only there for a minute. And the other thing that's really common is consumers, Lance, they're so predictable.
Yeah.
Do you know when 6.6% interest rate feels good? When it used to be 8.
Yes.
All
Yeah.
consumers want is a deal. And the other thing that's happened in housing is that there are life events. People get married, people have kids, people get new jobs, they get divorced. All of these things force this. And we have been stacking demand up when rates were 8%, just waiting. And I'm not saying demand's going to explode. I'm only talking about the margin.
Yeah.
At the margin, more demand is coming than supply, which means we will, quote unquote, drift higher. That's how the system works.
Yeah, I think, the opinions on the downside risk have really been minimized in a lot of ways. I was talking to Yield Street's head of residential research, and he was somebody who was in the 10 to 15% peak to trough heading into
Yeah.
2023, which he changed his tune pretty quickly. But right now, he told me last week he sees very little to none downside risk,
Yeah.
which was an interesting statement. I don't know if, and I don't want to have calls or anything, but I
Yeah.
think where
That's my job. That's not your job.
if you
I
want to
make
get
calls.
into seeing where the downside risk is at this point, I don't necessarily know if it is higher for longer is a great amount of downside risk because we've destabilized, and the only period that was destabilized was the rapid deterioration.
Yeah.
Now, if in some crazy way you got 10% mortgage rates,
Oh, that'd
um,
be a problem. That would be a problem.
but the thing is, that's not how the economy works. The bond
Yeah.
market is a reflection of the economy, and they don't
Correct.
really mismatch that much. And we are actually in a mismatch where
Yes.
we are in restrictive territory, and we've been in restrictive
Oh,
territory.
200 points. Yeah,
So,
absolutely.
to keep this economy all else equal, and then have the bond market run to some crazy level, it just doesn't it doesn't make a lot of sense.
Yeah.
Um,
Well,
it's
the other thing we should talk about is one of those leading indicators. Again, folks, is a leading indicator is mortgage apps. Mortgage apps do not equal purchase, but it does highlight interest. And mortgage apps, other than that Christmas week, are noticeably up. Is that true?
Yeah, mortgage purchase applications this week, which is last week, are back to April levels. So they shot up. And it's really a signal that existing home sales will probably tick up a bit. People call them mortgage demand. I don't necessarily know if I see it as demand, if a pure demand metric, because at the end of the
Okay.
day, if there isn't the resale supply to purchase, there's not going to be the applications for the mortgages. And so if people aren't moving, that's, so some of these measurements are supply and demand.
Yeah, no,
If
I agree, right? And from an economic perspective, just for the audience, demand is a two-step function. It's a willingness and an ability, right? A mortgage app is a willingness, but ability is like you got to have the inventory or you got to have the price point. There's all kinds of other things that happen. Yeah, demand's a two-step function. Most people don't get that. That's why I look at mortgage apps is just interest. Is the consumer getting interested in housing less or more? It's a very
Yeah.
much a leading
So
indicator.
that's an interesting way to put it. And I think building off of that, the most important signal with apps is not necessarily where they're at, but swings. So
Exactly.
if
It's
you
the
see them all moving down for a long period, very quickly, okay, you know what's going on. And last spring, mortgage apps shot up quickly at the beginning of spring and then went down. But that swing up, that was the market like responding positively, and that was when it
correct.
caught into that equilibrium that we've been kind of in since then.
Yeah.
Uh, so now one thing I should point out is that we are seeing pockets Florida softening. That is very real in the data. So
Yeah.
keeping an eye on that. But a lot of the places that tightened up last year, especially the West Coast, are still tightened.
Mhm.
Um, and so it is possible that home prices on a national level could increase 3 to 5% this year.
Yeah.
I'm making a call. I'm just saying, in a theory, it's
Yeah.
possible, and that some markets could fall.
Of
And
course.
the evidence that I would give for that is that's what happened last year, is that home prices on a national level went up 3 to 5%. Now, if you look at just the bottom of the market, there are indices where it went up 7, which is kind of wild.
Mhm.
Uh, but you still had markets that were down and in correction mode, like Austin.
Yeah.
At REI Club, one of the things I'm going to be watching very closely is not just the national market, but these regional pockets. And I do it through the actives data and I do it through the pricing data. And when you put them together, you see a really good,
Yeah.
really see the housing market on a
Yeah,
regional
I think
level.
I think what you're doing at REI Club, go to REI Club Analytics, give it your email, you get 5 free articles. But wow, the value is in the data and the charts that you produce. Uh, you know, what are some examples of some, give them a tease about what's coming.
Yeah, let me share my screen.
Oh, look at you.
Am I shared?
It's coming. Yep, there you go.
Okay. So I'm going to be doing a lot more zip code level data in the next couple weeks. This is for the pro members. So
Mhm.
this is the premium side. And so I have a free newsletter, goes out several days a week if you just put in your email. And then the pro is for people who pay to get 3 more a week, plus my
Yeah.
trackers.
No, it's the
It,
data, man. You do amazing stuff. The articles are great. It's worth the price of admission, but the data and the stuff that you're starting to pull at the granular level, what I would call a buy box, is gold. And if you're serious about your market, your buy box, if you're looking to buy and hold, you have to have this data. It's at minimum an insurance policy, but it also can be seen as a metal detector. So it's truly a way to find some gold out there. So please
so
keep it up.
it's not working right now. I don't know what's going on in
It's
my
okay.
data tool. But if you look at Ohio, it's pretty much 45% below pre-pandemic levels for actives, and
Yep.
prices are growing at normal levels. If you look in Texas, a lot of Texas has went back to pre-pandemic levels,
Yep.
and they're not falling like 10, 20% in a lot of these pockets, but a lot of them have come down 3% from the peak, or they're just
Mhm.
not really moving on price. And you go look at the upper tiers and they're down a little more. And so
Exactly.
there's softness in the market. But if I could zoom in all the way, there's a specific area in Dallas, oh, maybe at a show, where north of Dallas, some of these wealthier suburbs and good school districts, actives are still down. Oh, it's going to show me Ohio now.
Nah, a
Um,
little slow. Yeah.
but there's pockets of Dallas where actives are still well below
Mhm.
pre-pandemic levels. Prices are still moving up at a normal rate. And then the outskirts where inventory is above pre-pandemic levels, prices are down a couple percent. So it's
Oh,
interesting
yeah.
to put the two and two together. And
Yeah.
so here's what the zip code level data looks like. You click on it, it shows the zip code, the 4-year shift in inventory. So this specific zip code inventory is down 61% below pre-pandemic levels.
61%.
And
Active
there's
listings,
14.
14.
Yeah, now that is December, but well, no, actually
Still,
that's higher.
14?
No, actually that will go down because
Yeah.
that's the high part. Yeah, so not a ton.
Yes. That's crazy. Well,
Yeah.
folks, at the end of the day, we talk about focus, daily discipline, and buy box. If you want to get data that I didn't have when I was starting, you need to be part of REI Club, specifically the pro membership. Go get it. Well worth the price of admission. Lance, you're also going to be at the event in Vegas. People are going to get to hear you speak on Sunday.
Yeah, I'm gonna need to try to think of something interesting, but yeah, I will be there. Excited. I'm really a big fan of the community you built. You've done a great job. And actually, I did a little tweet thread today about like being a creator or a journalist today, and really one of the prime examples of that is you.
Mhm.
And the way to be a good creator and to reach a good audience and to do kind of what you've done is, one, you have to have the knowledge base. In my feed, my thread, I put that it's no longer build the audience and then the knowledge. It's really have the knowledge, then build the audience. And so really excited to, meet some of the people in your community and just kind of watch one rental at a time grow and take off. One of the reasons I do this every week and come chat with you is because I know that this thing that you're building is special and that it's
Oh,
going to continue to grow and it adds a lot of value for people.
yeah, I appreciate all of that. Again, you're coming out on your dime, which is pretty cool. I didn't have to pay you, or there's no fee. He's coming out because he cares about the community and is happy to be a part of it. So we'll see you in Vegas, and I expect a lot of pictures and Instagram posts with people tagging you. So it should be a lot of fun.
Awesome.
Thank you, buddy.